Hello, welcome to another episode of Executive Suite. I'm your host, Thomas Braun. Today we're here with Joseph Argiro, the founder of Iron Key Capital, which is an M&A advisory firm and a venture capital firm that services companies that are at the intersection of Web3 and AI. Joseph, can you please give us the elevator speech about Iron Key Capital?
Hey, Thomas. Thanks for having me on. Would love to. Okay, so Iron Key Capital is a venture ecosystem. So most people are familiar with Techstars, Y Combinator. These ecosystems help to de-risk early stage investing. And we've been building a private equity holding company that has subsidiaries that effectively help us navigate what we call new age venture capital, which is the venture capital landscape has rapidly evolved over the last 2 years because VCs, traditional VCs, don't have as much power because capital is a commodity and you can scale a business with AI a lot more cost effective, right? So you don't need millions of dollars to achieve scale anymore. So that levels the playing field a bit for founders, takes power away from the traditional VCs. And what we think is really the future of venture capital is a venture studio model where we have, and what's unique about us is that we have a private equity structure where we have a $1 million investment club, which is for angel investors who are building track record or emerging managers. And then we have a $10 million VC fund, which is part of our larger capital deployment strategy where we follow on to the winners of the investment club. So at the investment club, we use game theory, optimal venture capital economics to write small checks into as many companies as possible early, similar to Y Combinator. And then the VC fund acts as dry powder for follow-on capital for the companies that go on to raise more capital and really achieve product market fit. So between the capital side, the parent company, we are in the business of advisory and M&A when it comes up. And then we also have the R&D engine, which is the venture studio side when really we've been doing R&D for a couple of years at the intersection of blockchain, financial services, and what we came up with is a venture backable business is our first venture studio product, which we're putting a lot of our resources into, which is essentially the TV show Shark Tank, but as a software product in the blockchain space. And so we're a venture studio of one, and that's a little bit about Iron Key.
Tell us about Web3 and then how AI is changing that.
Certainly. So the tangible use case that I'll use for everyone to grab onto is in the Web3 space, there's been this idea of a DAO, which is a decentralized autonomous organization. So it's like a LLC or a corporation, but it's actually run rather than by a C-suite and a board. It's run by its constituents, by the members, similar to a member-managed LLC. And these DAOs started popping up around 2017. And before AI really hit mainstream in 2021, 2022, I jokingly say that these DAOs were actually disorganized autonomous organizations because it's very hard to coordinate humans and capital when no one's in control, right? So disorganized by nature. Now, AI has come along in the past year or two, which makes it a lot easier and a lot more cost effective and easier to coordinate humans and capital on chain to kind of get around some of those inherent human flaws like voter apathy, like not having people engaged, and all the things that come along with humans being unreliable. Agents are a lot more trustworthy theoretically. So that's where I would say just as a tangible example of how the AI space is really unlocking all of the potential in the Web3 space by making it smart and contextually aware. That's what I would just as a jumping off point, I would say like how these worlds are converging to create this, I'll call it emergent value, right? Like greater than the sum of the parts.
Okay. So, and that's creating a business opportunity, presumably, right? That's what you're
A
interested in.
large swath of business opportunities actually and the deals that we're looking at actually typically have a little bit of AI, a little bit of Web3, and they're at the intersection, interdisciplinary of all these different emerging technologies. And that's what we actually see getting funded right now by VCs.
Okay. So give me an example of a company that fits that description.
Yeah. So top of mind is our one venture studio product. So our venture studio product, the company is called Fish Network, which is Shark Tank as a software product. We use stable coins to facilitate liquidity and onboarding and offboarding for investors into compliant pools of capital on chain for retail investors to essentially level the playing field between institutional VCs and retail angel investors. So we're using stable coins as a mechanism and cryptocurrency as collateral to actually unlock liquidity in the private markets, starting with venture capital and moving into other alternative real assets as well. So by using Web3 rails, we're able to unlock liquidity, which I think is for traditional assets, which I think is the important part. And also, so in summary, that's really the Web3 side of the crypto applications, just using it to create a more frictionless, transparent, and trustworthy investment club framework using software and compliance and building that into the guardrails of the product. Now, on the other side of that is the AI side, where instead of a human or a general partner making an investment decision, which is common in private markets, whether it's hedge funds or venture funds. In our model, which is legally structured as an investment club in the US, all of the members are required to vote over where that capital goes. So rather than one general partner taking fiduciary and legal responsibility over the capital on behalf of everyone else, it's quite literally the opposite, where everyone contributes and everyone pools their capital to deploy that capital together. And where I'm going with that is rather than a human, it can actually be an agent to facilitate and carry out and execute against the wishes and desires of the community. And that's where the AI agent comes into play in terms of like the execution of the transactions, of taking human input, combining that with AI to actually make this a lot more seamless and frictionless. So that is a little bit about, it's the product that's near and dear to my heart right now. So that's the Web3 side and the AI side.
Okay. So, and if people wanted to, like, so somebody's got like an AI startup, most of these are web apps that are doing something. Would they be able to apply for this? Like, how do they get in front of do you call it fish tank?
Yeah, so our platform is specifically designed for emerging managers.
Hmm.
So our customers are new fund managers. So we are essentially creating a mechanism for the best founders to get funded in similar to the way crowdfunding works, but
Okay.
crowdfunding has a lot of problems because with charging upfront fees and for various reasons. So what we're doing is creating a mechanism for emerging managers to build track record and the best founders to really just show up and raise. So we're enabling the social coordination of capital.
Okay. So, how do the founders, though, get in front of the investors?
So the founders talk to an AI agent that processes a pitch deck and asks the founder questions on a 15-minute discovery call. And then the data gets syncs to the Fish Network platform, and then the agent will produce an investment recommendation
Hmm.
based on the data, the details that they collected from the founder, and produce actually an investment recommendation on behalf of the investor. So again, the tool is designed to be used for investors. The founders are just a natural beneficiary of this streamlined process. So that's how founders ultimately get in front of these emerging managers and their LPs.
Okay. So, and is this like by invitation only, or can anybody go? Is there like a website, web-based app that anyone could go to, or do you have to be invited?
It's a great question. So you can check out the website at fishnetwork.xyz. And right now, you do need to be invited, and this is how we control quality. So we're building about 4 to 5 high quality, professionally managed investment clubs in the US, and we diligence and KYC these managers to make sure that they're both competent in doing things correctly. But ultimately, into 2026, we're looking to unlock this on a software platform so that anyone in the world can spin up a fish school, which is an investment club LLC. And so that's a little bit about the go to market.
Neat. Okay. So now with Iron Key, you've got your angel fund and then you got the VC fund. So is the would you say the angel fund is meant for a seed round? Like, at what point should somebody who's starting up a new company be approaching an angel fund? Like, do they first have to raise, hundreds of thousands of dollars from their friends and family before they go? Or, like, what if it's somebody who hasn't raised any money at all, but they've got a great idea that they've been working on for the last 6 months?
Yeah, that's a great question. With our hybrid capital deployment model, typically invest at pre-seed or between pre-seed and seed out of the investment club. And then the seed stage founders are typically we're investing alongside other VCs in those institutional quality seed rounds. Now, what makes us a little bit different is that we're high conviction investors. We're at the investment club. So we're deploying capital into teams that are promising but not quite there yet. Through that process, we provide the advisory services to essentially help us de-risk that early stage investing.
Yeah. And because with a lot of these AI startups, they're not really capital intensive anyway until you get to that go to market stage. I guess you could use a little bit of extra capital, but generally they're, like you pointed out yourself, you can scale these things up with relatively less capital. So I'm just wondering if that really changes things, like with the stage at which people are willing to invest, because they don't need to go out and spend a ton of money on building a prototype or setting up a factory or something like that. And that's obviously one of the attractions for investors, but does that mean that you can invest sooner at an earlier stage?
Yeah. So the dynamics that I'm seeing change right in front of our eyes is that typically now you really only have an opportunity maybe once or twice to invest early, and then all the upside is captured. So we're looking at things between $7 and $25 million valuations. And then beyond that, all the alpha, in my opinion, is actually captured when you get to Series A and you're looking at $100 million valuations. So there's a big disconnect between kind of like where the bigger players are deploying capital and where the savvy investors that are investing at early stage, of which there's a lot less of us that are high conviction. I would say 80% of the VCs out there just follow what A16Z is doing, or Sequoia, or fill in the blank there. And that's typically the way VC has worked to date over the past 10, 20 years. But now I think the game is really changing so that the founders that can validate product market fit, they can scale a lot faster. So there's a much smaller window where it makes sense to come in as an investor. And then once they've achieved product market fit, then the valuation's 10x and you kind of lost all the alpha, in my opinion, of the reason why you should be in venture in the first place is to be early and diversified. And that's really our strategy.
Right. And also the time to get to that 10x. So even if that company kept growing, the next 10x might take years and years and years. And it's just not going to unfold as quickly, right? So you're also looking sort of at the time value of your money, where you want that cycle to occur a lot earlier. So it's going to be a lot easier to go from 3 million to 30 million than that next stage and the next stage, right? So I agree with you. So now, one of the things that I like to talk to people about, I think we've covered a few things with Iron Key Capital, but one of the things I'd like to talk about is just about your personal journey as a founder, why you decided to get into starting Iron Key Capital, and how long ago you got into this, and what you're trying to accomplish here.
Yeah, it's a good question to kind of take a step back and look at, why and how did this get started and why am I on this path? So we started as a multi-family office investing into liquid digital assets in 2021. And then FTX collapsed and all of the bankruptcies happened. And uh, we decided to hard pivot about 3 years ago into the venture space. And actually we made one private investment out of the hedge fund that was in a decentralized manufacturing company. So I think like Amazon plus Uber for 3D printing. And that company went on to raise about $9 million out of 5x markup. And that was the really one data point that kind of told us, hey, we're not terrible at this. Let's focus on this a lot more. And specifically venture in the blockchain space. And then this was all in the 2021, early 2022. Then uh conversely, at the same time, my first employee went through a program called Venture University. I actually went through a program called goingvc.com. These are called them venture capital training programs. And what we realized is that those programs left a lot to be desired. It was essentially like lectures and homework, like you get at a university. And that's not conducive to how you really learn venture. Venture is more of an apprenticeship industry rather than something you can learn by teaching someone. You get into venture by just doing the job. And so we realized that those programs were not very good, and we could build a much more inclusive and community that actually works on real deal flow at our syndicate and investment club rather than just kind of going through the training and motions when it's not real deals. So we decided to combine our syndicate and the education side so that it's one community. And so that was the basically what we saw in the market. And we saw an opportunity in the niche of specifically Web3 angel investing in venture capital. And the kind of vantage point of why did we get into that? Well, in the blockchain space, there's a lot of people on Twitter and YouTube that are, very social media forward about how great of a crypto trader they are, or whatever the case may be. But we saw a massive gap in the market of trusted thought leadership in the crypto venture capital space, specifically taking more of a media and distribution and thought leadership approach rather than kind of the old 2 and 20 model of, hey, let's just raise capital and then deploy the capital. That's the old VC model that doesn't work anymore, especially not with how fast the technology space is moving. So we decided to build more of a platform approach, and that does include software as a competitive advantage to provide distribution for our founders. So yeah, so I'm rambling at this point, but I'll pause there.
Okay. Well, no, that was a good answer. I think one of the things that I was thinking about what you're talking is going back to you're using an AI agent then to start organizing all of these people who are joining into the ecosystem that you set up. But what about using AI to actually identify the companies? Because right now, you said they have to be introduced or invited. Some of the other small VC AI funds that have been set up, they're actually using AI to also do their research into which companies, and they're using AI essentially as radar to try and detect at an early stage who the next winners will be. Have you looked into that?
Have from a market landscape perspective, actually been following that for the past 2 years. My hot take on this is that most VCs feel like they have some sort of proprietary way to evaluate startups. So they're less hesitant to buy a software off the shelf. There's not really a willingness to buy there. I do see a large majority of VCs actually trying to build their own type of, call it AI sourcing or vetting type of tools. We've done the same, but I would say, just as a general point, I'm pretty bearish on the actual, like, that, call it AI diligence as a product, as a software product, because I don't think there's much demand or willingness to pay on the VC side. However, I can't say the same for the private equity space, which I think is interesting. But so that's one vantage point. The other vantage point I'll say is that there are some efficiency gains to be had there at the margin, but I believe that I think there's a lot of just overblown or overhyped nature of what these AI tools out there are capable of. So I would tend to say that I think, at least on the institutional side, I think it's really humans that are going to ultimately end up making investment decisions. Now, on the more community driven side, I think that's might not necessarily be as true. But so I think, in short, in summary, there's a lot of people experimenting with it. I don't uh, necessarily think it's going to be all that impactful in terms of, changing the business model. I see it as a marginal improvement.
That's one of the That's one of the things they look at, for example, because then they think, well, this person will be able to get a lot of people using their app, and they have a built-in audience. What do you think about social media presence, and how much weight do you give that when you're looking at an AI startup?
That's a good question. I think I'd like to split it into two buckets, or at least this is how I compartmentalize this. Is that in today's day and age, you're either building deeply technical AI infrastructure, which is one bucket, and then the other bucket is really just using technology to make your business more efficient. And on that side, it's really more around clarity of use case and speed rather than and I just don't see really much happening in the middle. It's like I think that these as a founder, I think it makes sense to like really pick one lane because the middle road there has kind of been hollowed out by AI. So it's either deeply technical AI infrastructure or it's very use case driven, trying to solve a real problem and just using AI to do that. I'd really like your opinion
Hmm.
on the crowdfunding side is there's two dimensions that I'm thinking of. I'd be curious to get your take. Is that what I'm seeing is that, you know, crowdfunding, at least in the old, I call it the old model, or just people raising capital in just call it a Web 2 way or the old fashioned way. There's 10% of your costs that are going to operational and compliance just to meet the regulations, the compliance regulations to comply with Reg CF in the US. And that 10% almost, and then you have upper limits on crowdfunding limit sizes like around there's 1.07 million and then there's another limit at 5 million that they're where the juice is almost not worth the squeeze because there's 10%, fees that are kind of built in just to like all the laborious details to comply with Reg CF. And now what we're building at Fish Network is actually we have a way to lower those costs by using blockchain rails that cost $0 to build on, where in the Web 2 model, you're paying $2 to $4 per KYC AML for each retail investor that you onboard, that's really where the costs start to stack up in terms of like how is the crowdfunding model scalable, and we're just building on top of open developer toolkits that cost $0 to build on, so we can actually lower the operating costs of running a crowdfunding campaign. So that's one side of the equation, right? Is like reducing the operational complexity and costs, right? The other side is actually providing investors with a better experience. So let's just say a crowdfunding platform had groups that only focus on specific theses, right? So for example, you could have, they only want to invest in real estate technology, right? And let's show those people all the same types of deals, right? So that's one marginal improvement where I would say that probably is like table stakes of where the market is today with Web 2 crowdfunding. And where it gets even more interesting is that how do you know as an investor what's a good deal on a crowdfunding platform? Well, you really don't, right? Because the cost of doing your own diligence is time intensive, right? And if you're not writing a huge check, how do you really know, get a good understanding of the company? And well, one way to fix that is through social coordination. So on our platform, investors actually vote over which startups they like. So it's almost like social gamification and wisdom of the crowd and leveraging the other investors to help you make decisions so you can actually invest on your own. You can invest based on the wisdom of the crowd, or you can invest behind emerging managers that are domain experts in that specific thesis. And we gamify that with a points mechanism on chain. We have a social gamification layer and on chain track record layer that makes this a lot more open and transparent system for both investors, emerging managers, and founders to connect.
I want to thank you for coming on and sharing your insights with us. Fascinating to hear about Fish Network as well. And I invite people to go and see the other things you're doing on ironkeycapital.com.
Sounds great. Well, thanks for having me on, Thomas. I think it was an insightful conversation on kind of the ins and outs of private markets. And yeah, you can find me on Twitter at Iron Key Capital or ironkeycapital.com. And thanks for
Awesome. Bye for now.
bye.